At dawn in December 2001, a line wrapped around a Buenos Aires bank that no longer allowed withdrawals. People held folders, plastic bags, and envelopes, each containing documents that once represented security. Inside those buildings, gold certificates and deposit slips were technically intact, yet access to them had evaporated. What mattered in that moment was not ownership on paper, but permission to convert. No sirens marked the collapse. The financial system simply stopped translating private claims into usable resources. Outside, shopkeepers were switching price tags by hand, sometimes twice in a morning. Across the street, a man tried to barter jewelry for groceries and was politely turned away. Years later, many would remember that week as proof that gold preserved value. But memory often compresses survival into a single object, ignoring the systems that made any object usable. The same compression is happening again today, quietly, across digital ledgers and balance sheets. Liquidity is celebrated, reserves are praised, and portable wealth is marketed as insurance. Yet beneath those reassurances sits the same structural question. When institutions seize who controls conversion, this analysis is not about dismissing gold as an asset. It is about examining why, in real collapses, possession rarely equals protection. More precisely, it will show how survival during systemic failure depends less on what you own and more on how ownership is recognized. That distinction sounds semantic until institutions begin rationing trust. Before going further, one assumption needs to be questioned. Is collapse primarily a story of prices rising, or is it a story of permissions shrinking? Most people instinctively answer with inflation. History suggests access disappears first. Consider Russia in 1998, when ruble accounts were frozen and foreign exchange was suspended. Private gold holdings existed, but legal conversion channels vanished overnight. The metal remained valuable in theory. In practice, transaction networks had collapsed. This pattern appears again in Zimbabwe in the late 2000s, when hyperinflation made cash meaningless. Even there, gold ownership did not guarantee stability because enforcement and exchange collapsed simultaneously. At this point, the argument risks becoming too simple. Not every collapse eliminates markets entirely. Some systems fragment instead of vanishing. Informal exchanges emerge, while formal clearing systems freeze. That fragmentation is the first mechanism to understand. Collapse rarely destroys assets. It destroys coordination. To make this visible, a simple framework will guide the rest of the analysis. Think of every asset as resting on three layers: custody, conversion, and recognition. Custody is physical or legal possession. Conversion is the ability to exchange. Recognition is whether institutions honor the transaction. Gold excels at custody. It can be hidden, transported, and stored without digital infrastructure. What it does not control is conversion. That layer belongs to networks, regulators, and counterparties. Recognition, meanwhile, depends on social and legal consensus. Once that consensus fractures, assets float without anchors. Call this the translation problem. Value must be translated through institutions to become usable. If translation fails, theoretical wealth becomes inert. No amount of intrinsic value resolves that blockage. But even that model needs restraint. It applies most clearly to systemic collapses, not to isolated market crashes. During a banking panic, for example, conversion bottlenecks form quickly. Cash limits, capital controls, and settlement delays interrupt asset mobility. Under those conditions, gold competes not with fiat, but with access. Whichever instrument moves through the bottleneck survives. Already, modern parallels are visible in episodes like Cyprus in 2013. Depositors technically owned their balances, yet conversion was politically rationed. Precious metals held offshore fared better than domestic accounts. Not because of metal itself, but because of jurisdictional separation. This distinction matters. It suggests survival flows through infrastructure, not symbolism. At this stage, the narrative could drift toward romantic self-sufficiency. That temptation needs to be resisted. Most individuals cannot exit institutional systems entirely. They navigate within them, even during breakdowns, which means the central question remains unresolved. Why does gold fail to function as a universal lifeboat when systems fracture? The answer will not emerge from ideology or marketing. It emerges from studying how coordination fails, step by step. In the next segment, That failure will be traced through payment networks, legal freezes, and social trust breakdowns. Only then does the limitation of portable wealth become fully visible. When Argentina's banks reopened months later, many depositors discovered their balances had been forcibly converted into long-term government bonds. Gold owners, meanwhile, faced a quieter problem: finding anyone willing and legally able to buy. Markets had not disappeared. They had narrowed into thin corridors controlled by intermediaries. In Weimar, Germany, a similar compression occurred during the early 1920s. Gold coins circulated, but only within trusted micro-networks insulated from official oversight. Outside those circles, transaction risk overwhelmed nominal value. Counterfeit fears, confiscation threats, and enforcement gaps dominated pricing. Here, a clarification is necessary. Gold did circulate during crises, but never at scale without institutional scaffolding. The metal's usefulness depended on trusted assiers, brokers, and safe routes. Remove those, and liquidity collapsed. This reveals the second mechanism: intermediation fragility. Assets that require verification lose velocity when verification systems fail. Paper money relies on central banks. Digital balances rely on clearinghouses. Gold relies on trust networks. When trust networks shrink, gold's market shrinks with them. It becomes locally useful and globally stranded. Modern parallels appear in sanctioned economies today. In Venezuela and Iran, informal gold trade exists, yet operates within narrow corridors. Smuggling premiums, seizure risk, and legal ambiguity absorb much of the metal's nominal value. What survives is not gold's purity, but relationships. At this point, another assumption needs revision. People often imagine barter emerging naturally during collapse. Historical evidence suggests barter is a transitional fiction. Most exchanges still require some unit of account. Gold rarely becomes that unit. It lacks divisibility at everyday transaction scale and suffers from valuation disputes. During the Balkan conflicts of the 1990s, cigarettes and fuel often functioned better than precious metals. They were standardized, consumable, and immediately verifiable. This does not mean consumables outperform stores of value. It means transactional usefulness outweighs theoretical preservation in acute stress. The framework now shows two weak points. Conversion bottlenecks and intermediation collapse both restrict gold's function. A third layer is emerging: political visibility. Gold is conspicuous during crisis. Its portability makes it legible to authorities. Throughout history, emergency governments have targeted visible wealth first. From Roosevelt's 1933 confiscation order to India's 2016 scrutiny of bullion dealers, enforcement follows traceable assets. Private hoards become regulatory targets, not because they are immoral, but because they are extractable. Yet even this mechanism has limits. Not every state can enforce confiscation effectively. In failed states, local militias replace regulators. Extraction persists, merely decentralized. The implication is uncomfortable. Portable wealth attracts pressure wherever coercion exists, which brings the analysis to the channel's core identity. This is financial forensics, studying past system failures to understand what survives. Survival patterns rarely align with marketing narratives. They align with institutional continuity. Assets embedded in resilient payment, legal and security networks endure. Assets detached from networks become bargaining chips. But even that statement requires refinement. Networks themselves can ossify. During Japan's post-1990 stagnation, gold preserved nominal value. Yet domestic financial infrastructure remained functional, making gold largely unnecessary. In that context, institutional stability mattered more than metal ownership. Collapse had stalled, not detonated. So when does gold appear to work? Primarily in partial failures, where cross-border access remains. Eastern Europeans in the 1980s who held gold abroad fared better. The advantage came from jurisdictional insulation, not intrinsic value. That difference is subtle. It often disappears in retrospective storytelling. People remember that gold holders survived. They forget that surviving holders were embedded in functioning corridors. At this midpoint, the structure of failure is becoming clearer. Value preservation requires uninterrupted translation. Custody alone is insufficient. Conversion without recognition is sterile. Recognition without custody is abstract. All three must align. Gold reliably supplies only one. Still, An objection remains. What about extreme hyperinflation? In those cases, gold prices soar in local currency. Does that not prove its protective role? The answer depends on whether price can be realized. In many episodes, nominal gains could not be legally or safely monetized. During Yugoslavia's hyperinflation in 1994, black market rates diverged wildly. Converting metal often meant interacting with criminal intermediaries. Risk premiums consumed much of the apparent upside. Survival depended on personal networks, not charts. This complicates simplistic inflation narratives. Asset performance measured on paper diverges from lived experience. The contrast section now begins to emerge. What fails first is not value, but settlement. Clearing systems freeze, legal enforcement fragments, trust becomes localized. Under those conditions, large, visible, verification-heavy assets suffer. Gold fits that profile. Meanwhile, small, repeatable, relationship-based instruments circulate. Credit within communities, goods with stable demand, access to services. None of these look impressive on balance sheets. They look invisible in retrospect. Yet invisibility is resilience. Systems ignore what they cannot easily map. This is where many preparedness narratives collapse. They focus on stockpiling objects, not on embedding within systems. Objects degrade without context. Systems adapt. The remaining analysis will now shift to present conditions. Not to forecast collapse, but to map structural stress. Only through that mapping does the final synthesis become possible. Across today's financial system, stress rarely announces itself through headlines. It appears first as friction. Settlement times lengthen. Compliance layers multiply. Cross-border transfers slow. None of this looks like collapse. All of it looks like optimization. Yet historically, collapses begin this way. Translation capacity erodes before prices explode. Consider the growing reliance on correspondent banking networks. A shrinking number of institutions now clear a growing share of global payments. Concentration increases efficiency. It also concentrates failure. When one node freezes, entire corridors stall. Assets trapped behind those nodes become locally stranded. Gold does not bypass this architecture. It merely shifts dependence to different intermediaries. Vault operators, transport insurers, customs authorities, and dealers form another clearing layer. That layer is thinner than most people assume. Recent disruptions in global logistics expose this fragility. Refining bottlenecks and shipping delays temporarily decoupled physical prices from futures markets. Even in calm conditions, translation wobbled. Under stress, it would fracture. A boundary must be drawn here. This is not a claim that gold is useless. It is a claim that its usefulness is conditional. Those conditions are institutional, not material. Another present signal lies in regulatory expansion. Know Your Customer rules, reporting thresholds, and transaction surveillance are now embedded everywhere. Visibility has increased faster than resilience. Systems see more, but stabilize less. During crisis, that imbalance matters. Highly visible assets become administrative targets. At the same time, informal credit networks are re-emerging quietly. Peer lending, service exchanges, and reputation-based commerce are growing beneath formal layers. They appear inefficient. Historically, they are survival substrates. Here, a self-correction is necessary. Not all informal systems are stable. Many collapse into predation. Trust can curdle into coercion. Resilience does not mean harmony. It means persistence under strain. Which brings the framework to its final synthesis. Custody, conversion, and recognition must align across multiple jurisdictions and time horizons. Gold secures custody well. It weakly secures conversion. It cannot secure recognition. That structural imbalance explains its repeated disappointment in full system failures. It preserves memory of value more reliably than access to value. What actually survives are pathways. Legal pathways, social pathways, logistical pathways. People who endure collapses rarely describe saving themselves through objects. They describe maintaining channels, channels to food, channels to work, channels to protection. Assets matter only insofar as they keep channels open. Once channels close, assets become stories. Return now to Buenos Aires in 2001. The man with jewelry outside the grocery store was not rejected because gold lacked worth. He was rejected because no conversion pathway existed. No assayer, no trusted buyer, no enforceable contract. Inside the bank, depositors faced the same problem in reverse. Recognition existed on paper. Conversion did not. Both groups owned value, neither controlled translation. That is the deeper lesson obscured by retrospective myth-making. Survival was not about holding the right thing, it was about remaining inside functioning systems longer than others. Some did that through foreign accounts, some through professional skills, some through community ties. A few did it through offshore bullion, not because it was gold, but because it was offshore. Collapse, seen this way, is not an explosion. It is a slow misalignment of layers. Custody drifts from conversion. Conversion drifts from recognition. Eventually, nothing lines up. When alignment breaks, portable wealth does not rescue, embedded access does. That reality is uncomfortable. It offers no simple talisman. It demands attention to institutions, incentives, and dependencies. It rewards systems thinking over stockpiling, and it reframes what preparation even means. Not accumulation, but integration. In that Buenos Aires morning, people waited with folders and envelopes because they still believed in translation. They believed institutions would reopen the channels. Some were right, many were not. Gold did not decide their fate. The structure of access did. That structure, more than any metal, determines what actually saves you when systems fail.